Hey everyone, Douglas here, and welcome back to the MMT Macro Trader. And we are doing a live stream tonight. So welcome aboard if you are here for out of the gate, if you will, to kick things off. My game plan for this video and just for tonight is to go over some kind of broader macroeconomic topics. I spend most of my time, most of my energy really focused on the market, investing, trading, that sort of thing, and really creating models and different analytics to really understand the kind of active trading side, what our market's going to do, and I build those up from the MMT standpoint. But I am certainly not unaware of just the broader macroeconomy and potential implications, and I do see that there are definitely some benefits to just understanding the broader macroeconomy, but sometimes the analysis that really I'm passionate about doesn't really make its way into kind of these sort of discussions that I intend on having tonight. So that is my goal for tonight, and really for all of these live streams, is to use this as a space. One, if you just have any questions for me and would like to kind of pick my brain on MMT stuff, I've been doing this MMT thing, or at least investigating, learning, applying MMT to not only broader macroeconomic world, but also investing for close to 9 years now. It was about 9 years ago that I saw the debate between Warren Mosler and Robert Murphy, MMT versus Austrian, and just the light bulbs were flashing, everything clicked, and it all kind of made sense, and that's what really kind of changed my entire outlook. I could tell that story sometime in more detail, but 9 years. And so if you have any of kind of history with this MMT stuff, so if you have any questions, by all means, fire away. Tonight, I want to talk about a topic that is obviously near and dear to a lot of people's hearts. We're going to talk inflation. We're going to talk Fed. We're going to talk rates. Go over this entire idea, and again, it's going to be geared a little bit more towards just kind of broader macroeconomic theory, not necessarily applicable to trading day in and day out, but still, I think some worthwhile discussion to be had. So where I want to start is really where I started for this entire idea for the live stream, and that is on last Friday, when the jobs data came out. I was watching Twitter, and just the Twitter feed come out, and everyone, with bated breath, seeing what the heck is going to happen with these with the payroll numbers and the unemployment data, and the implication that was going to have on the Fed in terms of what they were going to do for interest rates, and ultimately, hey, welcome, Jesus. I did have a light bulb moment. Anyway, I mean, I was watching everything just kind of play out, and just the I don't want to say the irony, but the hilarity of people watching to see employment numbers come out, to how it's going to affect the Fed, and how the Fed is going to make a determination on where to set interest rates, and the impact that might have on the broader economy. Because from an MMT perspective, right, and then you'll see this, right, and then you'll see the articles come out, the Fed is behind the curve, the Fed is behind the curve, the behind inflation, et cetera, et cetera, et cetera. From an MMT standpoint, the Fed is the curve, right? I mean, and that's where I kind of laugh at all this conjecture regarding from what's the Fed going to do, where are they going to set rates, how are they going to see things. From an MMT point of view, and just, it's not even an MMT point of view, this is an absolute fact, right? The Fed is the monopoly price setter, not only of the effective interest rate, right, the federal funds rate, but really the entire curve all the way out to the 30-year. If they wanted to, they could have whatever interest rate at the entire curve that they wanted, not only through the tools they have, but if that's what the Treasury and also I guess you might need an act of Congress to just completely set an interest rate at a certain level. Either way, it is still an arm of the federal government that would make the determination to set the interest rate at whatever level it wanted. So here's the Fed, and this is kind of where the hilarity of it all comes in. Here's the Fed waiting for information to set a rate that it has monopoly control over, that actually in turn is going to set further policy. There'll be like a domino effect of further policy and implications, and they have the entire thing backwards. And that's really what we're going to talk about tonight, is how to grasp the whole idea of inflation, rates, everything that's going on right now from an MMT perspective. I'll also talk a little bit about where maybe I've been a little bit surprised over the last 6 months, year, what's causing the inflation. I think I have a few things underneath me. I want to talk about inflation, different types of inflation, whether that be demand and supply. We'll talk about the Fed rates, term structure prices, which is really, I think, the best model to use for kind of what inflation is. It's a Warren Mosler idea. And then if any questions come up, I will certainly address those as they come up. So that is what is on the docket tonight. And again, I think probably the best place to start is again with this idea that the Fed is the monopoly price setter of interest rates. There is no free market that is determining interest rates. In fact, if it wasn't for the Fed willing to pay interest on bonds, right? Bonds are a vestigial of an era where the currency was backed by something, right? You had to get the bond, issue the bond, and then the government could spend. When you depeg and you have a free floating currency, and it's only backed by the good faith of the government, et cetera, that sets up a scenario where the government is free to create the money for whatever it sees fit, for whatever policy purposes it wants to accomplish. And when you're in that situation, you don't have to issue bonds, right? I mean, the whole bond issuing sequence of things, again, is really just a kind of a structure that was built up under now a bygone era. So the idea of then having an interest rate, right, paying interest on those bonds is really it turns out to be kind of a futile endeavor, but it's not really affecting anything. And yet it does, in the sense that there is a lot of money that is being priced based on those rates. I mean, a good way to think of bonds is really a free income for people who have money, right? It's the government paying people who have money to go ahead and instead of keeping their money in a savings account, to go ahead and put it in some sort of investment account with the federal government, and they'll pay them interest on that money. So again, we're going to kick things off with this discussion of the Fed being the monopoly price setter, and then what the impact is when they do actually end up setting interest rates. And the question is, how does the Fed determine, right? How does the Fed determine where is it going to set interest rates? And effectively, and the Fed will publicly state this, they have three things that they're going to use. They're going to use inflation, they're going to use growth, and then they're going to use employment. And what I have pulled up right now is the 10-year yield on TradingView. And I can show you that, in fact, this is exactly what the Fed is looking at, because you're going to see that all three of those things are highly correlated to the interest rate. And again, this will tie into the broader inflation discussion. And if I see a few people starting to come on in, so if you do have any questions, by all means, fire away into the chat, and I will address those. But have the 10-year yield pulled up, and like I said, they're looking at three things. They're looking at inflation. They are looking at you know what, John M., I don't know if the Fed will hike rates in June. My guess is they're going to continue forward with it, and hopefully by the end of this, you'll kind of be like me in the spot where I really don't care what the Fed does so much as I'd like to understand just the broader implications of what. I mean, I guess in one sense I do care what the Fed does. That does change things potentially, right? But I think what you're going to realize is there's very little consequence of this. In the sense of that they set up how they set rates and what happens. I mean, really, the only consequence of setting rates is, one, it can potentially cause inflation, and I'm going to get into that later. That is a potential concern that I do have long term, is that you could end up getting a spiral of inflation because rates are being pushed higher. And the other thing too is some investment strategies will use the interest rate to kind of adjust their portfolio in terms of the mix of bonds to into stocks. So that is also kind of a common thing that will happen. And so you will see a bit of a rebalancing that does occur when rates go up as bonds become more tempting than stocks. And I can talk about reverse repo in just a second. So let's get back to this point real quick. I'll try and stop going down rabbit trails and kind of get to a few of these points, and then we'll loop back to questions. Again, rates follow three things because the Fed follows three things: inflation, employment, and growth. And so I'm going to turn on oil here as a bit of a indicator of overall inflation. And what you'll see is oil correlates very strong with rates. Oil pushes up, rates go up. Oil drops, rates are going to come down. Now, there are a lot of other factors kind of obviously pushing and pulling on this entire correlation. But generally speaking, when you see oil, which is going to be one of the main inflation drivers, when you see oil starting to push higher, that is going to be an inflation driver, and so that should be an indication that rates are going to start pushing higher, all things being equal. And then usually it's oil that pushes high enough where, especially before the great financial crisis, and then also in like late 2014, early 2015, oil just stays a sustained price that the economy just can't handle anymore, and then it begins to eat at demand. So it's usually the oil cycle, and so oil is going to push interest rates higher. And insofar as the Fed has their own tools to look at inflationary pressure, they're going to see that the energy prices is pushing things up. The next thing the Fed looks at is they also look at growth. And so again, I have the S&P 500 overlaid with rates, and likewise, you're going to see a relatively strong correlation between rates and interest rates and the S&P 500. Again, when the Federal Reserve starts to think that growth is pushing higher, they are going to raise rates. That's their cue to raise rates. And I'm going to talk about, too, in just a second, the why, because I think that's kind of important, why the Fed thinks this is the case and why they're actually wrong. And it's because that they're wrong of their models that could lead us into a really desperate spot in the not too distant future. So the next correlation is going to be growth, and the final is going to be unemployment. So I can show the unemployment rate. This is inverted, by the way, so this is better called the employment rate. So I've inverted this again just to show the correlation between the employment rate and rates as well. And so those are the three biggies that the Federal Reserve is going to be looking at to set the interest rate at what they do. And again, because they are the monopoly price setter, the entire curve eventually, obviously they only set the effective funds rate, or the federal funds rate, but this is what's going to happen with regards to the rates as the certain inputs come in, and the Fed takes into account the certain data points, then ultimately makes a decision. So you can really say that the curve, bonds, the entire interest rate game is really just traders guessing what the Fed is going to do, which again is a bit ironic. And the Fed, I don't think they realize that they are the monopoly price setter, right? I think they have control to a certain degree over the curve, but they're going to set it wherever they want. So big question is, why the heck do they do this in the first place? Why are they setting these interest rates? And the kind of prevailing theory, like the Keynesian economic theory, is that the higher the interest rate, the more constrained that's going to make, the tighter that's going to make the business cycle, lending and whatnot, right? So the idea is higher interest rates, less lending. That's going to slow down the economy, and then achieve the goal of slowing the economy down. The only problem is, and the Fed has realized this, in the years following 2008, and quite a few other countries, central banks have fully understood this. And the problem is that whole theory rests upon this idea that you can actually lend out reserves, right? That there's this lending of whatever deposits are on the books that can be lent out, right? We're not in that regime anymore. Effectively, we haven't been in that regime for well over 100 years now. Even before the Nixon finally closed the gold window, we still were very much not in that regime, right? The regime that we're in today is that loans create deposits, and that is the de facto regime. And in that instance, I'm not convinced, and maybe there's some good research to show otherwise, but I'm not convinced that a higher interest rate would or wouldn't necessarily deter loans. I think there are, actually, I know what what sets a loan. You go into a bank, you say, hey, I want to buy a home, and they see if you have enough income to buy it, and they see if you're a stand-up enough person, or at least they're supposed to, and then that you're good to pay the loan back. And as long as you have enough income, and you'll get a monthly or paycheck every other week, then they're going to give you that loan, and they're going to max it out to as much as they can justify, and that is really justify based on your monthly income, and that is really a policy decision, right? So it's a state regulatory policy decision that is actually setting if new loans can be created. And at the end of the day, I just don't see how raising or lowering interest rates is going to spur on economic activity in the sense that the Fed wants it to. Now, the Fed has admitted as much that this isn't really how it works. Some other banks, the UK Central Bank, the Indian Central Bank, have come out and said, "Yep, we just had it wrong the entire time." The Fed is like, "Well, the regime's changed." And actually, John, this will get to one of your questions too. Your second question there about reverse repos. The regime has changed. There's a ton of reserves now in the banking system, and so things are different now, and the Fed tools that they use are different to achieve their monetary goals. But what the Fed is really missing, especially when it comes down to setting the interest rate to try and set economic policy to do something, what they're missing in all of that is that it's actually regulatory policy, not the interest rate that's going to affect that aspect of things in terms of issuing new loans that would spur on or contract growth. And then also there's just the natural business cycle that does occur. There's a debt deflation dynamic. Hyman Minsky, Steve Keen, not Stephen King, Steve Keen, that entire dynamic that is also at play. And can have its own kind of the natural weight of the entire dynamic just falling apart. And I do think that actually plays a pretty big role in it as well. We'll talk about that. So that is really kind of the main factor. Is there just enough income? And if there is enough income, are banks willing to lend? And they are. If there's enough income, they'll always have the incentive to lend in that situation. And so, and that's actually why, that really is what the explanation is for 2008, right? We saw a massive contraction in income because the budget deficit, the fiscal flow was so low that we saw just essentially not enough income flow through the economy, and people couldn't pay the mortgage on their house, and the housing market was unfortunately completely tied to the banking sector, and all the banks went belly up because the mortgages were slightly undervalued, and that blew up the entire banking system, and there were fire sales everywhere. So that was really the cause of 2008. Had the federal government just given out a stimulus check or something like that, or just cut like FICA taxes or something to that extent, we would have never had a 2008, right? Everyone just would have continued to pay their mortgages, and things would have gone on until eventually, obviously, it would come to a head eventually. But it was a policy mistake more than anything else. So I think now that we have kind of figured out this whole idea of what's pushing the Fed to set interest rates, where the interest rate's going, what is kind of the cause and effect of it all, I think probably the next idea to really hit on here is going to be what the effect of everything is, and let me see. Is this really the chart that I want? Yeah. Let me start here. Actually, let's start with this idea of inflation, because we're now going to tie interest rates into inflation. So I have the Wikipedia page for inflation pulled up, and kind of modern, and I do want to tie this into kind of the inflation that we're seeing right now, and some potential issues that we might end up seeing down the line if things kind of stay on the path that they are. So in just kind of normal Keynesian terms, this would be just we'll start with the status quo at least. There's this idea of three different kinds of inflation: demand pull inflation, cost push inflation, and then built-in inflation. And you can quickly read the Wikipedia inflation write-ups right here, but I do think there's this neat little graphic, if I'm not mistaken, it will be maybe a little bit easier to just kind of see on Investopedia. So demand pull is when demand for goods and services exceeds the production capacity of cost push when production costs increase. And then when built in is when prices rise, wages rise too in order to maintain the cost of living. And it really seems like a lot of people would like to blame demand pull inflation for what we're seeing right now. But I'll show in a little bit. I'm seeing a question pop up here. Is it Jesus or Jesus? I'm going to assume Jesus until Moser said they should have eliminated the payroll tax and people would have had enough money to continue to pay their bills and banks wouldn't have had needed the bailout. Yeah. I mean, Warren and I are on the same page. He's obviously on a level of this that I only wish to get to. But I mean, he's absolutely right. And I think that's kind of where I got my idea from too. And it plays out. I mean, it completely plays out when you really get into the accounting dynamics. So he's absolutely right. Anyway, a lot of people like to say that it's this demand pull because there were massive stimulus checks that were handed out. And so everyone's got more money. They're bidding things up. And certainly to a certain extent, that might be part of the case. But I recently... Jesus. Okay. There was a tweet by Joe Weisenthal recently just put out on his newsletter, and if you're not following him, the stalwart he is on Twitter, he hosts the Odd Lots podcast for Bloomberg. Super good thinker. I just really appreciate people like Joe who are just constantly critical in all the best way of any thought, and is definitely willing to think things through. As critically and open-mindedly as possible. But anyway, he posted a few pieces of his newsletter that was sent out, effectively just showing that in terms of demand, that demand for gasoline has essentially remained steady post pandemic, and that I'll pull up the second piece here, and that the push of the oil price is clearly not associated because of a demand side, and that in almost any spot you look, it really seems to be a supply side issue. And so this idea that the reason we're seeing inflation is because of massive stimulus really doesn't have the backing when you look deep into the data, right? So I'm definitely of the impression right now that the reason we're seeing inflation is, one, because there's a monopoly price setter of oil, and that is Saudi Arabia. They always issue the last barrel, and because of that, they have the monopoly monopoly capacity to set the price, and they will push it as far and hard as they can before they break the economy. They did it in 2008. They did it in 2014-15. They will do it again if they see fit. And so they are the monopoly price setter, and it is a supply issue because of that. So as long as they are trying to push the price higher, it's going to be pushed higher, and there's really nothing else that we can do about it. So going back to this idea of inflation, I do think it is a cost push style inflation using the kind of the Keynesian terminology and using the Keynesian terminology, it's cost push. However, I do think there is an inflation. The point I'm going to get to, I do think there's an inflation that is, and really I think it's the right way to understand inflation. There's a path to inflation that only MMT understands. I refer to it when I refer to it as monetary inflation, specifically because it is a monetary policy that is setting this style of inflation, and we'll look at that in just a second. So again, just kind of at least we all now have in our minds the similar ways of our definitions of inflation, and then what is another driver of inflation, and this is where I think we could start seeing things get kind of nasty if this monetary inflation that I'm about to explain ends up kicking in. And I actually get this from Warren Mosler, so I'll give him credit where credit is due, and I'll link this video when we're all done. Actually, I can probably just do that right now. If you're in the chat, I will go ahead and do that right now. If you want to watch this, he essentially lays out his theory on inflation and what he calls the academic definition of inflation. And the idea that he puts forward is this concept of the forward price curve, right? And if you're in trading, you'll understand this idea of a price curve, right? So there are different month contracts for almost anything you can trade, right? From oil to S&P to dollar futures to anything, right? Lumber, whatever. There are different month contracts, volatility and whatnot. And so oftentimes how these contracts price themselves is there's always some sort of premium on the contract that is further out in time, right? So I'm sorry, the phrase that he uses, term structure prices, right? So there's this term structure of prices of really everything that is traded, because usually there is a premium on some sort of agreement further down, because something can happen in the meantime that could change, that could change the price, right? So I mean, a good example of this is oil, right? Generally speaking, a barrel of oil today is going to cost less than a promise for a barrel of oil tomorrow. There's storage cost that has to go into it, but even if there wasn't, there still is just risk involved. And so if you're going to agree upon a future price of oil, you're going to want some sort of premium, and that is called normal backwardation in the term structure of prices. From time to time, though, because different dynamics are at play, you can actually get into this dynamic called contango, where instead of the future price being more, the future price is being less. All right. So in other words, if today the price of oil is 120 barrels, and 6 months from now it's going to be 125. Sometimes it can be 120 today, and in the future 115. And the reason for that is that the market is pulling forward kind of the fear and volatility, or there are other dynamics that can cause this, but generally speaking, it's the market that's pulling forward some sort of fear, some sort of priced in volatility dynamic, and therefore putting the market into contango. And this same thing happens in the world of interest rates. And it's the interest rate, and this is a point he makes, it's the interest rate that is setting the price on everything, because it's the interest rate that is setting the price of doing business through the channel of borrowing, right? So the point he's making in this video is that if you're going to do business, and let's just take an extreme example, but if you're doing business and you have costs of $1 million a year, right? And all of a sudden the interest rate is set at 100%, so it's going to cost you 100% more to operate because you have to go get that loan to operate the next year. You're going to price everything in 100% higher. So if you're operating at $1 million right now, you're going to operate at $2 million right now, or the following year, because that's where the interest rate is at, right? And then everyone else in the market's going to do the exact same thing. And so you have this dynamic that happens when interest rates go higher, where essentially the price of doing business is going up, and that is something the Fed is setting, right? And so in a crazy way, the Fed has things completely backwards, right? Economic theory is completely inverted to reality. As they raise rates, that should spur on inflation in so much as the economy can handle it from an income channel standpoint. In other words, as long as there's enough income rotating through the economy fast enough, inflation can continue to go higher until it finally outpaces the amount of total income. So that would be particularly the fiscal flow channel begins to kind of diminish so much that it's not a sustained income, right? In other words, what I'm saying is, let's just say the deficit every year is $1 trillion, right? Well, if inflation is 100% 1 year to the next, well, that $1 trillion is only equal to half of that, right? 500 billion the year prior, right? So inflation will slowly compress over time. Every new dollar coming into the private sector. So there is a dynamic happening, and that is eventually how you can crash an economy, is you can get inflation going hot enough. But we have so many line items from a fiscal flow standpoint that are adjusted to inflation that you would just keep, in theory, you could just keep the income channel from the fiscal flow is just pushing higher and higher, like Social Security and whatnot will just get pushed higher. Medicare will just get pushed higher in that scenario. And those are huge line items from a deficit standpoint. So there is that aspect to it. So let me now kind of go through some of these steps and to a certain extent prove out what it is that I'm saying and kind of show you that in fact what Warren Mosler, and from my understanding, I haven't seen anyone piece this together. And part of the other reason too I want to do these live streams is if you are an academic, these are ideas that I've thought up. I kind of just put them on the back burner because they turn out to not yield anything like a terrible amount of insight from kind of a market trading standpoint, but they're still fascinating, and I still think they're right. So if you're an academic, if you have some sort of paper that you can publish, and this would be a topic that would be of interest to you, I would love to talk to you. I mean, this is definitely one way. Reach out to me. This is one way that I really think some of this stuff could really get out there in a more meaningful way. Part of my own, my own back of the mind altruistic desire in all of this is to get this just in the broader public. And definitely an easy way to do that is just show that you can consistently beat the markets with these ideas. Unfortunately, there's not much I can do to beat the markets with this idea of what's actually causing inflation, but definitely willing to help if assist and kind of flesh out some of these ideas if you're an academic and you'll have time to research this some more. So let me show you what I think is some of the stuff that is relatively fresh, or is relatively original and fresh to the world in terms of just kind of proving the point of what Warren Mosler is trying to say. So what I have on screen right now is the federal funds rate and the velocity of MZM money stock. Now, they discontinued MZM money stock, but the point will still be made here. And the idea that I'm trying to get at is effectively, if velocity of money is velocity of money is how many times the money supply rotating through the economy, right? And this is just an agreed upon inflation measure, right? Classic Keynesian economics. We all agree if money rotates through the economy fast enough, that will cause inflation, and they're absolutely right. And that I don't have any disagreement there. So if velocity is an important component to the overall inflation kind of piece in this, then what's driving the velocity? Well, from Warren Mosler's standpoint and from this term structure of prices standpoint, it is the interest rate, right? I mean, the interest rate is the determining factor for how fast we should be expecting the velocity of money to be. MZM is probably not the best measure, but it's good enough. And you can see the correlation on the screen right here, right? I mean, I don't really even have to kind of spell it out, right? Velocity of money overlaid with the rate of change, or the rate of change of velocity of money overlaid with the rate of change of the federal funds rate, and you end up seeing the dynamic that is actually at play, right? What is actually the dog wagging the tail? The dog is the federal funds rate, and the tail is the velocity of money, and it's also why the velocity of money has collapsed for the better part of 2-3 decades now in the U.S. because back in the 1990s, Alan Greenspan started on this path of lower interest rates. Lower interest rates, all things being equal, is disinflationary, and so we've been on this disinflationary path where velocity of money continues to crash. And so I do think that is absolutely the explanation for why that is occurring. And yeah, I mean that's kind of the punchline to all of this is I absolutely think that the interest rate is what is actually driving the inflation rate. And this is, amongst other things, obviously there are components to this, right? There are policy components, there are supply components and everything else. But this too is really, this is the insidious inflation that can run away. And my big worry is, and this is kind of the big point that I want to make in all of this, my big worry is that this could get out of hand, because usually what ends up happening is you end up seeing, and this is going to tie back into why we set the foundation out at the start of, what's causing the Fed to set the rate where it is. There is just a natural business cycle dynamic that's playing out. Okay. And this business cycle dynamic plays out, and what's happening is you get this kind of credit impulse. You get the private sector borrowing that increases aggregate demand, that increases GDP. You get this cycle of higher prices, and it's that expansion that the Fed sees in stocks as growth, right? In oil as just kind of the general inflation, and you're going to see unemployment go lower, right? Because you're seeing an expansion of credit that is going out, and so the Fed is seeing that, right? And they're saying, whoa, we're getting inflation, we need to raise rates. Well, they usually see it at the point that it is just naturally topping, right? They will start to raise rates coincidentally as inflation is just naturally occurring because of the business cycle, and it's usually that topping point of the business cycle, and then you'll see things give way, and just in the natural course of the business cycle, where the weight of the credit cycle hits in, and then that depresses the rest of the economy, usually just because of some kind of demand rug pulled, if you will. It depresses the economy, and the Fed kind of releases its foot off the gas, and then the cycle starts over again. And this can be seen in something like, so one of the things they'll use to determine when to kind of take their foot off the gas is the tool that I have pulled up called the Chicago Fed National Financial Conditions Index. And when this thing gets, too close to zero or above zero, that's the Fed's way of knowing, whoops, we might have gone too far, and we're going to start to take our foot off the gas, so to speak. And so eventually the Fed will take its foot off the gas. But again, there's that point that usually the credit cycle is what does it. Here's the thing: if you're if you're on my Patreon. If you're one of my Patreon subscribers, you know this. We recently just saw the big washout in the credit cycle. The credit cycle completely collapsed, and it's looking like it's starting to reverse course. Usually at this point, the Fed has taken its foot off the gas and is starting to lower interest rates. Right? I mean, I forget what the exact drop was, peak to trough in the stock market, but we've seen a good enough cut in the stock market, but we obviously have these supply chain issues that is keeping the inflation part of this pushing higher, and we still have fiscal flows that are absolutely rocketing once again, right? I mean, we're going to start seeing fiscal flows push through the roof again, and we're already seeing that. It looks like maybe, although there's still time to see here, but it looks like the credit cycle is starting back up again, and I think we could see a scenario where we just see the Fed raise rates into an expanding economy, thinking they're going to shut this thing down. And it could be a while before the next cycle gives way, and that could get really nasty. This has always been in the back of my mind, kind of one of those things where I'm like, I don't think it can happen, but if it does happen, it's not going to be a lot of fun. So that is definitely a worry of mine. And one of the questions that was came up on one of my old videos is, what about do you think we can get into stagflation? I made a video about why I don't think we'll get into stagflation anytime soon, and I don't, because if we do end up seeing demand, stagflation in the 1970s. You had a diminishing demand and a diminishing fiscal component, growth component, as well as inflation soaring because of essentially a supply shock, right? The oil embargo, so you had this perfect storm. Well, we do have the supply shock side of things. We still are going to have the growth demand side. At this point, it doesn't look like that side of things is going to really fall off a cliff. It could, but it doesn't look like it. Particularly the income channel, so the fiscal flows, it does not look like it's falling off a cliff anytime soon. So it seems as though we're going to continue to have that portion of it play out. And I don't know what the Fed is going to do. I mean, we'll see. I think I forget and I can. I don't know how I'll pull this off, but maybe during the next video I can follow up. And I know there's the tool out there to predict, what the market thinks the Fed is going to do during the next rate hike cycle. So it'd be the June rate decision. So I mean, we'll see what the Fed ends up doing, and if they do a quarter point. I wish I had that ready. To be honest, I don't look at it that often. I don't look at it until the week of the decision. So we'll see what the Fed wants to do. But if they continue on a rate hike cycle, I certainly expect the velocity of money to start to kick up, and that more insidious inflation could easily kick in, and we could be on a bit of a wild ride, as it could take a while for the market to fully digest that and actually slow down. And yeah, I mean, we could see oil get extremely high. That seems reasonable. And in fact, one of the things I wanted to bring up here is the inventories for oil right now just continue to absolutely collapse. I use a specific model. I mean, for now, we'll keep it for the Patreon members. It's called a comparative inventory model. Art Berman put it together, and I think it's absolutely right. It continues to support higher and higher oil prices, and undoubtedly it's been spot on. But you can see insofar as the oil inventory from Cushing, Oklahoma, I mean, it's collapsing. We're seeing collapsing inventories consistent with supply shortages here. So from that extent, I see no reason for a sudden reversal, major reversal in oil. And when we do get the reversal in oil, I mean, be fair warned, right? Especially if we get a shot higher in the dollar, right? We see the dollar index explode higher, which we kind of did, but we see that in conjunction with oil finally collapsing. That's when things get dangerous, because that is private sector or foreign central banks that do have access to oil to sell. They are fire selling oil to fulfill whatever dollar obligations they have, and you get that little short squeeze in the dollar. When that happens, be forewarned. It is not going to be a good time for the market. But in the meantime, I don't see that happening anytime soon, and we could see oil continue to push higher here, given the current regime. So maybe we need a 40 work week to reduce the consumption of oil. Yeah. I mean, yeah. Yeah, I mean, maybe something like that would. I mean, really what we need is a coherent energy policy, a coherent energy policy in the nation, right? I mean, I'm not going to get into my own politics, but I really think we should explore more than just oil. And here's the other problem too, just to be realistic. We could go all electric cars tomorrow, et cetera, right? We could do this green grid. None of that means anything as long as we're still burning coal to do it, right? Even through the best coal burning plants out there, the cleanest coal burning plants, none of it means anything, right? I mean, we really need a holistic energy policy from top to bottom that really wants to address, everything, not only from the impact on the climate, the impact on the environment, but also the impact on the broader economy. And we just don't, I mean, we are light years away from a comprehensive energy policy. And so there are some definitely good ideas out there, and people who know this deeper and more than I do, but yeah, I mean, right now, at least hemp fuel, I mean, anything. Yeah, I think you get the point. Let me read this next question. You had mentioned rate hikes, higher costs of business. Wouldn't this reduce demand? Fed can't control supply, so their only tool to tame inflation is to kill demand. Yes, I don't even think they can kill demand. I mean, I really think higher interest rate could create higher demand. Let me back up. The demand channel in all of this is really the income channel, and the income channel begins its life as fiscal flows, right? And I can tell you, fiscal flows are. I measure two kinds of fiscal flows for the models that I create in the analytics I have: a raw fiscal flow and a net fiscal flow. Effectively, the net fiscal flow is the raw fiscal flow is all spending by the government, right? That doesn't subtract any deposits that they get back, right? So it's all just withdrawals. So withdrawals being then deposits for the private sector. So that's raw. That's just the spending they have. And then there's net fiscal flows, which removes taxes and anything else the government spends back in. In terms of raw flows, we are as high as we've ever been, and no real sign of letting up. And the massive tax receipts, if you saw my last video, I think I put something in there about the tax receipts. Maybe it was 2 videos ago. But the tax receipts are starting to dwindle, and so the net flows are starting to push very strong, and that is the income channel, right? So when the when the Treasury spends, what federal government spends, they are spending into the private sector, and becomes private sector savings, which then becomes the income for the private sector. And the point I was making with this whole idea of the inflation or of monetary inflation with this idea of velocity of money. Well, when that velocity of money starts to pick up, that is more aggregate demand, right? I mean, it will go through the economy faster and faster. The income that's in the economy will start going through the economy faster and faster. And so that is a risk. I mean, what will end the bubble is one of two things. It's the income that will be relatively lower because inflation is higher, right? So in other words, if you have $1 of income this year and inflation is 0, and then inflation is 100% next year, and you still have your same $1 of income, well, your $1 of income is only worth 50 cents. Right. And so eventually there comes this kind of equilibrium tipping point where you just are you're even though you have a budget deficit, you're actually in surplus when adjusted for inflation, right? So there is that dynamic that I think will play out, and is definitely what will kill the demand, right? So Nick, I hope that answers your question. Let's see. What else do I want to cover? Give me 1 second to go back to this window right here. I mean, I think it's kind of hitting on the main points that I wanted to get at. One thing that I didn't cover, again, to show this idea of, and going back to this idea too, of the price structure of the term structure of prices. What I've done is I pulled up the first and second or the forward month and then the following month contract of gold. That's what is on top, and set that against the 10-year interest rate, right? So I'm essentially showing, is gold in contango or is gold in backwardation? And what you can see is, as interest rates go higher, the gap between the second and first month of gold pushes higher, right? So you see this play out in real time where the future cost of doing business pushes higher. And again, this is the term structure of prices, and that's what's really and bear in mind the gaps here in the chart. Those are when there is a misalignment of the futures contract. So I mean, just pay more attention to the moving average that I have underneath there, more so than those gaps. Or I mean, that moving average can kind of help you see through those gaps. But I mean, the whole point is, as interest rates go higher, the term structure of doing prices go higher, and you see this across pricing in all commodities, right? No matter what, because there is that really demand push because of higher interest rates, right? I mean, it's playing out exactly what Warren Mosler set out to demonstrate in his theory, and I think you see it pushing through. So, good question. I don't think interest rates. I mean, I joke too, like in terms of interest rates, right? In terms of making decisions, I've never made a decision based on an interest rate, right? Like in terms of when we had to buy a new house a few years ago, right? I mean, the decision was my wife wants a new house, right? I mean, that's just what it was. I mean, that's how the decision happened. And I know I'm being a little crass in how I state that, but I mean, at the end of the day, if whether you're a business and you want to grow, whether you're an individual and you just want to consume, you're going to do it based on whatever, either, on a consumer level, what life circumstance you're in. If the wife wants a new dishwasher, you're buying a new dishwasher, right? If you want to continue to grow your business, if you want to continue to pay your employees and not lay them off, you're going to, you're going to go. And if you think that the profit's going to be there, right? And the profit should be there because everyone is in the same game and they're all going to raise their prices. So if the profit's going to be there and you can continue to grow, you're going to do so, right? And I don't see, I've yet to see the channel of higher interest rates actually pushing the economy lower again. I really think every time that we've seen, and I'm thinking primarily, obviously 2008 great financial crisis, 2012ish a little bit, again in 2015, 16, 2019, and then the COVID financial crisis. At each time, the Fed has had kind of had to pull their foot off the gas on the interest rate hikes. It has because just the natural rotation of the business cycle, primarily the private debt cycle, finally gave way, and yeah, and I mean the cycle just completed. So let's see, is there anything else I wanted to touch on tonight? Yeah, I mean I can bring this up to the private debt to GDP. Again, the whole idea here is, and if I turn this to percent change from a year ago, the whole idea is you get this surge in private debt, and this is a bit lagged. And unfortunately, I wish they would get this information out a little bit sooner. One of the tools that I've created is looking at the bank's balance sheet to essentially create a proxy for this. And it actually correlates a lot better. Our bank flow data correlates a lot better than private debt to GDP does, but it still is good for demonstration's sake. But you get this slowdown in the acceleration of private debt that then kind of triggers the debt bubble to burst. And again, when you're able to look at this at a more granular level, you see that consistently this deceleration is happening more just in coincidence with the Fed starting to raise rates than anything else. And it's because as this accelerates, you see, going back to this, you see as it accelerates, you see employment pushing higher, so unemployment pushing lower. You see, because there's just more demand, right? The private debt is a demand, is part of the aggregate demand equation, right? So it's going to expand, and you're going to see that consistent with oil, right? We saw the big push higher in 2008. We saw the big push higher in 2012 in terms of demand from the private debt channel. Same thing with the S&P, right? You see this thing push up, and that happens again. It's one of the inputs. It's not the end all be all, but it is definitely one of the inputs. So that is one of the definitely one of the drivers. And I just don't see raising interest rates is slowing that down. So I think what I want to do now is jump to one question that I have yet to address on here. And I also had this pulled up. It never really came up in discussion. I can Chicago Fed National Activity Index. This is what the Fed uses as their benchmark. They have some stupid name for what they're. I forget what they call this, but anyway, it's really their main tool they use amongst a couple others to determine growth. And it's really when it gets below zero that they'll take their foot off the gas. Same thing with the Fed National Financial Condition Index. When it gets above zero, it's kind of an indicator to take their foot off the gas and start slowing down. So if you really want to know when the Fed's going to fully take their foot off the gas, and those are a few things to pay attention to. If you find that, it will be helpful for your kind of trading and investing. To finish up though, Q&A, reverse repos have been exploding. What exactly does that mean? Reverse overnight, reverse repo. Let's type this out. Overnight, reverse repurchase agreements. Let me make sure that I am pulling up the right one, which I am. Yeah. So we've been seeing a steady incline going all the way back from April of 2021, and then we kind of paused there from the beginning of the year into March for reverse repos, and now we've been seeing an acceleration. And what's happening here is, so years ago, before the Great Financial Crisis, the Fed would manipulate the interest rate because there was always a demand for reserves, right? Banks would go create loans, and there would be a need for reserves because there would be a reserve requirement at the end of the night, and there would be reserves that were needed. And so the banks would go out and get those reserves in the overnight market, and that is how the Fed affected the interest rate, right? That's how they set the federal funds rate. After 2008, they had this brilliant idea of just shoving reserves onto the balance sheet of the banks, right? They forced the banks to have reserves, not bonds. That's called quantitative easing. And so the Fed takes all the bonds, and the banks are left with reserves. Well, the problem is you can't do anything with reserves, right? By definition, it's money you can't do anything with. It's only good for bank-to-bank transactions, right? So all these banks have all these reserves that they can't do anything with, right? We've already discussed how loans create deposits, nothing to do with reserves. Now, there are regulatory requirements on the makeup of the balance sheet of the bank that requires so many reserves, but it's not like a law of nature that's having any of this be impacted. And so what ends up happening is banks just have too many reserves. And actually, the Fed, another point too, is that the natural rate of interest would always be zero, right? If it wasn't for the Fed doing what it is they do, the interest rate would always crash to zero. It's the Fed coming in and really actually propping the interest rate higher. Well, the Fed had this problem following the great financial crisis as they put reserves onto the balance sheet, that when we finally went into the post-COVID era with the massive influx of fiscal spending, banks just had an enormous amount of reserves, so much so that they had no more balance sheet capacity to do anything else, right? They were hitting up against a regulatory constraint. And that's why we had a little bit of a tantrum in, I think it was February of 2021, where we had this little pullback that occurred. And eventually the Fed is like, whoa, we have to reduce some of the balance sheet size and give them more capacity to create loans, because they were just hitting up against the regulatory ceiling, if you will. And so what the Fed did is they're like, okay, we'll let you in this overnight reverse repurchase agreement. We'll hold on to the reserves, and then you can repurchase them later. Well, why are they screaming again? Well, as it turns out, it was the end of the year when fiscal flows started to slow down, right? And that is, that's when they started to slow down. There's a bit of consolidation, and now they're starting to pick up again. So you're starting to see fiscal flows at the banks again, and the banks are starting to get reserve constrained, and they need to offload those reserves, and that's why they are firing higher. And that's effectively it. It is a tool to fix a problem that was created because they didn't know how to use the tools they had in the first place and realized it after the fact. So, John, I hope that answers your question. And I think they have it pretty figured out now in terms of, I don't think we'll see the tantrum that we did initially. I mean, occasionally, I think some sell-offs are because of this, but I think they're relatively short-lived, and banks now have a place to put their excess reserves. And then to finish that point too, one of the things the Fed does now, how they are during zero rate policy, how they also affected rate policy is not only did they have to put a floor on rates, but they also had to put a ceiling on rates, and so they'll pay for a interest on reserves as well. So the banks will get a little interest on the reserve. So they've had to now play both sides of the goofy game, and I mean, it is what it is. It's hard. I mean, it's the game they set up and they have to play. I mean, it's all kind of a big pointless mess that just makes bankers richer, but so be it. In the grand scheme of things, occasionally it impacts the broader markets, but usually if it does in any impactful way, it's resolved relatively quickly. They'll come up with some new tool to take care of things. Hopefully that answered that question. Let's see. I think we hit all the main points I wanted to hit tonight, and I think I'll call it a pretty successful stream. All things considered, so I'm pretty happy with how things turned out. If you like this video, make sure you hit like. It'll really help out the YouTube algorithm. I assume if you're here, you're probably subscribed, but if you're not, make sure and do so. And then also, if you are not yet subscribed over at the Patreon, thanks Jesus, I appreciate it. MMT Macro Trader over at patreon.com, link below as well, and you can check that out. Also, my Twitter handle is linked right there. Follow me on Twitter. I'm posting there now, a little bit more active too. I'm just going to try and grow this thing. I've been kind of just been a bit of a hobby for a while, and I want to make it a little bit better, a little bit bigger, and start to grow it. And if there's any ideas you have for live streams, let me know. Right now, I think I'll do this every other week. Unfortunately, it is hard for me to set a schedule. I normally don't talk personal life, but I have a wife. I have 4 children. We homeschool. I'm very busy. So sometimes it's hard to nail down a date in time more than just a couple hours ahead of time. But my goal right now, at least twice monthly. Already, I'd say the success of this kind of excites me to do this maybe a little bit more often. So if you do have any ideas, by all means, drop me a line on Twitter or something like that. DM me on Twitter, or get in touch with me. And insofar as the idea touches kind of just the broader macro economy, I'll be happy to discuss it. Obviously, if you're an active trader, active investor, check me out over at Patreon if you want some of that kind of more precise predictive analytics models, that sort of thing. That's over there. But for the broader macro economy, this is a great place to share that stuff. So I think I've said everything I want to say tonight. Thanks everyone for hanging out, and I think I will go ahead and wrap things up there. So until next time, good trading everyone, and we'll talk to you then. Bye bye.